Well, it just doesn't get any bigger than this when it comes to investing and trading in markets. Will the Federal Reserve do a 25 or 50 basis point cut? And of course, the worst 2-week stretch in history since the 1950s. The data points are absolutely phenomenal in this week's video. So let's talk about the most traded zones being hit for not only the S&P 500, but also the NASDAQ. And of course, the market opportunities around the world as our favorite gold continues to go ballistic. But could there be other opportunities as well? Well, that's why we're looking at stocks, commodities, and cryptos in this special weekend edition. Join us, guys. This will be a great one. Well, welcome back, everyone, to a very special edition of our weekend show. This is, of course, part of our daily series. And if you love markets, remember to subscribe and smash that like button. But it was what happened during the week that I think was most interesting. Massive rallies in the semiconductors as things started to heat up there. And as we suspected, we could be in a monstrous kangaroo-style market into the US election. It's going to be a huge event. Just before we get into the data, though, I want to remind everybody, if you're from Melbourne or Sydney, you've got to make it out to our free event that we're doing in the month of October. Make sure to sign up in the links in the description down below. It'd be great to meet each and every one of you, and we look forward to doing it as well around the world very soon. Let's talk S&P 500 seasonality. We need to talk about September because, of course, many people are freaked out about the data points for the next 2 weeks, and rightfully so. September, as we know, is the worst month of the year seasonality-wise, but this year we started to see a sell-off early, and of course we've since recovered. Now that's very important when it comes to what's going to happen next, but you'll notice here since the 1950s, the Goldman Sachs data basically points to this being the worst 2-week stretch, and it's very important to save a little picture of this chart. You can jump it over on our X account if you're interested, links in the description down below, because of course you really want to know about July as well. July and March runs are historically very good, and of course this is the worst stretch in history. So FundStrat's Tom Lee says that there's a good chance that we're going to get incredible volatility into this rate cut, and rightfully so. We do know the data points towards that direction. You can see here Grant Hawkridge's chart shows the negativity that often comes in around this particular stretch. Here's another way to visualize it. When we start to go kangaroo at the beginning, often we do see a sell into the end of the month. And I think what I'm kind of trying to say here is we need to keep an open mind to both situations. Are we at a key resistance? Yes. We'll look at that later on, along with the positive gamma situation we're in right now. But of course, when we had the big close like we did with a negative 4% to positive 4% week just this point, we know that things start to shake up a little bit. If we had ended negative this week, there was a great chance that next week, as in one coming, would be incredibly negative. But because we didn't do that, we have to look at a couple of other data points. When we go into this period with a 4-month win streak overall, we've never generally topped in August. So we've got to remember that the chance of the market bull run being over is historically very low. Whether we come back in October, November, or December, though, will be the question. We also need to know that when we went from a negative 4% week in the start of September to a positive 4% week just this week overall, that this basically brings us to a point where it's going to be very tough to go with the statistics that say that the next 2 are going to definitely be negative. So we've got to keep an open mind. And you can see why this is when we looked at when markets peaked overall. October and November and December tend to bring the biggest peaks in markets, and December has an amazing track record of getting it done. Percentage total is 52% of the time markets will peak off in that particular month. Wow, I actually was surprised when I saw this stat myself, so I'm sure a few of you were like, that's pretty interesting. Let's have a look at the VIX. What about the volatility? What does it suggest? Well, even FundStrat's Tom Lee's data and other data points are pointing towards October actually being even more volatile than September. And when we have big September moves, we often still also get big October moves. So it's not over yet when it comes to the VIX, and probably not over yet when it comes to extreme volatility in a kangaroo-style market such as we're seeing. So how does this help us as traders and investors? Well, remember back into August when we were making videos talking about the VIX futures and term structure. We know that volatility tends to spike into October and then starts to drop off as we approach the US election, often diving back down into the December period and then ramping back actually into December, January, and February periods overall. And this is actually at the moment what the structure looks like. So if you're interested in getting this type of data, remember to sign up for our newsletter, as this was one of our kind of exclusive shares this week in our newsletter report. So make sure to look at that as well, because we will be sharing a lot more into this Christmas to make sure that everybody's aware of so many different charts and how they could be impacting us, whether we're an investor or trader. Days of the NASDAQ being down over -1% and closing +2%. This is also an important statistic. So far, we've looked at the fact that most Septembers are negative. Okay, cool. The back end is usually pretty bad. We also know that when we've seen similar situations, such as the run into August for markets, that we probably haven't topped. That's signaling that maybe buy the dip could be the better situation here over the next couple of months as we lead into the US election. And even with a rate cut, of course, the speed of the rate cut this week from the Federal Reserve will be important. We do know that these large moves often still signal overall bullish movements. So here's another stat here from the S&P 500 being down over 1.5% earlier this week, but then closing up over 1%. And that led to overall a more than a coin flip chance that markets would be up. In fact, it was 77.3% of markets that were up 1 month later and 3 months later in similar statistics. Now, some of you rightfully so said, well, this could also be the beginning of a massive sell-off. Sometimes we do see this. And it's a very interesting statistic. It matters where it happens, and it also matters what happens straight after that prediction. So if we end up going to a new high, it often does give us pretty good runs. So of course, if we end up with a new high over the next week, you've got to start thinking about all those thrust, those breadth indicators, everything else we've been discussing. We are also climbing what we call the wall of worry. We know people went into a bit of a freak out over last week. Hopefully you guys didn't, because we were putting out mostly bullish content as we've been talking about. And we saw the spread in sentiment go right back down to where we've traditionally started to see buy the dip style processes come in. Of course, we were watching things like the semiconductors in particular. And when NVDA broke that call wall, it went absolutely ballistic. We also know that the broad AI expectations of the market, this is Goldman Sachs, JP Morgan, and all the others, they're all pointing towards, yes, we could technically go higher. Are they probably being unrealistic about how much AI stocks are worth? Well, I would say yes, but you've got to remember we're in the AI bubble right now. So realistically, while you're in the AI bubble, you've got to think about the unexpected, and you've got to really follow that price action and be realistic about where we are in terms of the process. We do know that people are spending in late cycle style as well. We've talked about utilities being a big performer, gold being a big performer. If it's your first time here on the channel, these types of things should have you kind of cautious in the markets over the next year. We've been a long believer here on the channel that we're in what we call late cycle. We're beginning the late cycle, which can last anywhere from 1 year generally to even 2.5 years in terms of overall size. Spending also is important to note because, of course, people are living on credit. And we can see that realistically on this chart here. When we look at real after-tax income from 2019 and we look through to now, we can see that people are spending on credit more than they have been in a little while. And this is, of course, a concern when you're pushing it forward over time. But are we as leveraged as we were in, say, 2021 in markets? Well, the answer is simply no. Here's a chart showing you over leverage in markets, and you'll notice that there could still be rules to go with. Basically, people could still take on more debt, the markets could take more leverage, and we're not in what we would call the absolute danger zone from that perspective. And I think this gives you a little bit of an idea of where we're going towards in this video. Yes, we will experience volatility over the next month and a half. Yes, there's probably going to be great opportunities in this kangaroo style market. But overall, at this time, we are still leading into the potential of a new high on markets, and more importantly, still a bullish overall run. And that's because, of course, JP Morgan, Goldman Sachs, Morgan Stanley, and all these other places are still going towards the overall net EPS increases. Remember, the big thing here is going to be earnings must live up to their expectations. If they do, they'll keep buying in. CTAs will keep buying in. And by the way, we've got a great CTA report in just a moment. But then there comes the question of the Federal Reserve. What is this Fed going to do? Are they going to do a 50 basis point cut like many people are suspecting? Are they going to do a 25 basis point cut? Well, the speed of the cut is very, very important. And you can see here that the market is actually currently pricing in so many cuts that they're calling basically recession. So will we see a bunch of cuts and then more of a stabilization of the cuts? Now, on general kind of terms, we would expect around 1% of total cuts to 1.5% of total cuts to come through, and then a stabilizing force. Basically, that to be the cutoff rate. We're not going any lower. We'll see how we've kind of protected the economy. In a recession style outfit, what happens is we continuously see the Federal Reserve cut, and in fact, they'll need to cut upwards of 4 total percent. So 400 basis points of cuts. And this is where the market is disconnecting a little bit from possibly the bullish structure and what the bonds market, or at least the interest rate expectations are. Remember, right now, we're predicting, based on interest rates, the recessionary path. Yet the markets are not following that recessionary path. And this is where an open mind is very important. The next couple of months of structure from markets will be all important. It's what we've talked about now for over a month on the channel. We've discussed the idea that when we get a cut, usually there's negativity in markets. There has been the last 4 times over. The first 10 days can be very up, down, all around. So we'll have to keep an open mind to this. But it's the market structure afterwards that will tell us everything. Do we continue to lean towards negative structure and go down? Or are we going to see massive growth in these structures? And when we start to see new all-time highs, when we start to see big runs on the market towards the upside, we'll know that we're most likely in what's called the non-recession path for the first 12 months. And this is important because, of course, we do believe there is a recession. The idea that their Federal Reserve will soft land, I don't think that's going to happen. But we want them to celebrate the soft landing first. We need everyone to celebrate and be all in. So let's look now at what the immediate dangers are. Dark pool transactions. As you may be aware, they've been pretty helpful over the last couple of weeks to navigate these markets. Well, it looks like there's a couple of big ones coming in particular, short ones. So we've just hit a critical point on the Qs, a critical point on the S&P 500, and obviously a lot of markets are starting to sink with some resistance points leading into this week. Big transaction here, dark pool sweep overall on that particular short ETF. We've also got big ones here on the S&P 500 3 times leverage fund, where we saw a big trade come through and now a secondary trade right on the dot where you would expect possibly a short to actually come in. So this is pretty big, certainly worth keeping an eye on, and it points towards this being a cautionary level for even bulls when it comes to markets. We're at that key resistance that you want to be watching. We also did see some pretty deep kind of buying on Google and other stocks last week, and some of these led on to decent buys. And Google's an interesting one because, of course, it's so far down now compared to the other Mag 7 stocks that maybe it's kind of going to buck the trend and possibly continue to find buyers. We would say that that's most likely a buy because so many transactions went through that 150 strike. And of course, it's something we reported on. Let's now take a look at the rotation. So as we suspect, if we want this market to look healthy, it must be led by the bubble. In this case, it has to be led by semiconductors. Well, that's what we actually saw. And we also saw a recovery in commodities, which is something we're watching very closely because, of course, we've been talking about copper bottoming off for the last 2-3 week process. We've been, of course, loving gold. Gold, we still believe, is going 3,000. Might even have to upgrade my gold call maybe to 3,600 in the future, so that'll be interesting. And we're continuing to see this late cycle kind of narrative play out. What was most important over the last 5 days is things like healthcare and staples were down. But one to watch is going to be financials because they started to look a little weak. And of course, if financials and energy stocks continue to weaken off, let's say they continue to do really poorly over the next 6 months or 3 months, this could be a very big warning sign of where we're at in the markets. We will report if we get some kind of read on that because that's going to be super important. On the Friday close, we saw things like home builders doing really well. That's a good sign that bulls are back in the markets. We saw regional banks improving. That's good because, of course, they were suffering. And we saw all of the kind of more reinflation trades actually coming through, / a couple of cut trades. Let's now jump into the S&P 500 charts before we look at the options flow. What is the options flow telling us? All important, and we'll show you why in a moment. Well, we did get some positive overall delta on the candle here. You can see that a lot of the transactions were done at the top, which is interesting. And this, I think, is a very important zone. We know it's the most traded zone. And if we get rid of that for a moment, we look at the weekly, you can see it smashed straight into these resistance highs. So we're at a critical resistance leading into a critical week. Let's now take a look at the futures market, which is where we like to be. First up, advanced decline line continues to improve. Now that's showing you that the bottom 493 stocks are improving, but that doesn't mean that necessarily it's great, because although it's fantastic breadth, we're still not seeing that super increase in the leaders. So of course, if you actually look at the Mag 7 stocks like we did in our previous video, I'll link it at the end of today, then you'll see a chart in there that actually shows that the Mag 7 stocks have stopped leading this market, which is something that of course we will be paying attention to. Great bounce last week, fantastic wick led us on to believe that this would be the next level of equilibrium for markets. We've now reached this area, and of course, I think day traders will be specifically looking for traps around here and possible shorts in this particular area. Now, if you've got a little bit of a larger time horizon and you're willing to hold through the next kind of volatility period, of course, I don't think this is a negative for markets. It's a very strong rally, and it's more part of that kangaroo overall story that we've been discussing. But could we see a pullback this week? Well, I think there's definitely possible. And one of the key levels I think we'll be watching is specifically this 55 kind of 20-ish zone. So there are a few reasons why it could be a good level. Let's have a look at the options flow first. And I've left on here, I believe, last week's chart. And the reason I want to leave it there is because I want to talk about the 13th here. We talked about the 56 kind of 10 to 20 zone being a critical resistance where markets would flip to massive positive gamma. And you'll notice why. Look at that zone. Absolutely phenomenal from the resistance standpoint. Markets gravitated to it just like that. Let's now take a look at how this week looks when it comes to the options flow. And you'll notice that we're in positive gamma and that markets are actually deeming still towards the positive side. So it's really interesting because, of course, everyone's negative. There's no doubt. X, YouTube, everyone's going the next 2 weeks is going to explode. We obviously know there are some data points here that almost completely negate what's going to go on over the next 2 weeks. So what we have to do is keep an open mind. What's going to happen here on the price action will be very important. And I think that specific levels here are going to be key as well. Whether we go up, what if we hit something like a 56.50 early in the week? Could we still see a sell-off from this point? Absolutely, we could. And I think 56.40, as you can see here, and 56.50, this is going to be that massive res level that you'll have to pay attention to when it comes to how does the market interact with it. Leading into something like the FOMC decision, which is going to be a rate cut of some kind, leading into, of course, the CPI data, we're sure to see quite a lot of vol, and some people may take some profits from what they were actually getting into last week. So it's going to be one of those patience, react, don't predict situations. You're going to have to be sitting there and setting alerts and waiting for something that gives you edge on the markets. Could that be a dip into something like that most traded zone we looked at in the moment? Could it be a breakout of this new high and therefore say, okay, well, now I'm looking for further momentum moves due to CTAs having to buy? Both very valid. But of course, we're at that critical res. Do we really want to be trading a trade right now? Well, I would argue better off finding a better decision. But anyway, let's have a look at the CTAs. Okay, S&P 500, new high here for CTAs. We suspected they were buying last week. It made sense. Why? Because they freaked everyone in retail off. And then, of course, generally funds were purchasing. CTAs are behind the curve. So if we get a new all-time high on markets, they're probably going to have to continue to purchase in. Notice here in the NASDAQ, it's the same thing. And they're also behind in a few other markets. Not specifically Brent, but we did think that Brent was being purchased up late last week, and it was. And you can see here the CTAs are starting to get into it. So this is, of course, oil, for anyone that doesn't know. And then we've got gold as well, with a huge breakout that we're very happy with. Of course, we've been looking at gold and silver as big bull positions all year, and they continue to do very, very nicely. And you can see here the CTAs absolutely skyrocketed that breakout. So they're firmly in the momentum call for gold. So that means that basically if we get pullbacks in gold or silver, it's likely at this stage to be met by bull demand. Let's now take a look at a couple of other stocks. What are they suggesting? Well, it's the same story across the stocks. Key resistance points. Look at 120, the call wall sitting here for something like NVDA, a massive resistance, certainly worth paying attention to. And then, of course, there's Tesla. Tesla showing the same thing. We know 230 is the key res. We've talked about it for a few weeks, and guess where we closed this week? Bang, straight on 230. Why? Well, we don't want to pay out some of those retail traders. That's what the hedgies think. So in this case, 230 is, of course, the big positive gamma. If we move there, where do we go? I would say 250 is the next strike that is interesting on Tesla. So some incredibly exciting times to be in markets, and we love it here on the channel. I hope you guys do too. Let us know in the comments down below. I read some of yours over the last couple of videos, and I got to say thanks very much, guys. Some great additions in terms of just your thought process. You guys are smart. I can see it in the comment section. Not those dirty spammers though. And yeah, report the spammers, because I've been doing it, and my goodness, they just keep coming out. We don't want people getting scammed by weird spammers in the chat. All right, let's go through US 2-year versus 10-year. We're firmly in an inversion of yield curve. That again tells us we're in late cycle. We're in a point here, if you have a time horizon of a couple of years, to be ultra cautious in markets. Why? Well, these don't tend to end very well, yeah? So it's going to be one of those times where you need to keep up with information. You need to become more informed. And you're not being a stupid idiot if you say, I think these markets are stuffed right now. These are the types of things that you probably should be starting to say, because things are detached. You know it's unrealistic. It's just like 2021 all over again, when we went into hyper growth stocks that were like, the best thing that's going to go on is we're going to have a company that has unlimited growth, but we make no money and we're going to lose money for 20 years. Did that make sense? No. Did it go for a long time? Absolutely. And that's the point. Bubbles tend to last longer than you think. Yeah. And they tend to be bigger than the last one. RSP overall, very strong move here. Great weekly close, huge weekly rejection wick off the 20 daily or 20 weekly moving average. And we know this has been a huge buy zone so far on the way up. And it continues to be one of the biggest defense levels. So keep RSP on. Make sure you got your weekly 20 set. We love that indicator. Let's move over to the US dollar. Looks pretty bad, doesn't it? This could be a huge weekly close coming up this week after the FOMC decision on rates. Important line. We've had that there for a while. We know that if we end up going underneath this zone and closing, that could really bring not only parity, which is 100, but 99.50. So 99.50 will be the next zone to watch on these charts. Let's move to copper. Copper hit resistance. Watch reaction here level. We get through this. Copper's back on board in terms of we've got metals kind of running. Still watching copper, still watching iron ore. Obviously, we had the day trade over the last 2 weeks that was very, very nice towards the bull end. Let's now have a look at US oil. Hit the watch reaction here level. So far, it's been pretty strong. I'd say smaller bulls are now starting to position long for something like oil. And you can see here that it's already started to find some nice resistance breaks. It's obviously in supply. We're not through that really clear swing break, I guess, level yet. But pullback, something like a 67.50 kind of level, that's going to be an interesting point. Do we end up getting a buyer off that? Probably going to be a post-CPI style trade. Again, patience, react, don't predict could be the best in that scaling kind of position. But it does look like we've hit a critical support, and it's likely there is a buyer here on oil. That's the first time we said that in a while, because of course it's been absolutely free falling for a bit of a period. Now, what about gold? Well, congrats guys. I saw a lot of people in the chat saying, wow, I love gold. This has been a great year for it. Yeah, look, it's got good times and it's got bad times. Even if you're a gold bug, you must admit it tends to suck when you hodl it over too long a period of time. We're in the period for gold. Why? We're in a currency war. And remember, it's BRICS versus SWIFT. It's a huge component here of the gold trade. It's not the only component that I'm doing it off, but it's good to be right sometimes, and we are definitely correct in this case. So, of course, nice breakout here, and we've seen that kind of move towards the upside. 26.28, could we get to that res? This is kind of the run that I'd like to see for gold before it finds maybe a little bit of stability. Pullbacks at this point should be met by bull demand. It's a pretty big breakout. That's a serious deal. We've also got CTAs starting to buy back in, which means they're super behind the curve. So they're going to have to potentially start to ramp their gold buying up as well, which can create momentum. What about silver? Beautiful break, better even as percentage. Silver doing amazing. We nailed this one. You guys did really well. Congrats to you. And we're moving towards hopefully 31.20 and possibly even that key level of 34.50-60 zone. That's that second TP zone. I'd like to see silver really bang out a massive profit here overall because it's so behind gold. Remember, if you put silver versus gold, which you can do like this on the TradingView charts, then you'll notice here that silver is not even close to what we think is a possibility here of 0.015. Now, I'd like to see silver trading at 0.015 at some point over the next year. Is it doing it yet? No. but it's starting to look like a double bottom. Pretty interesting level there. Let's move over to Tesla. Not bad close, but certainly not quite getting through the goods. Now, we mentioned 250 before. I think that'll be an interesting point if we break through 230. And you can see that when Tesla traders get on board, they go ballistic. At the moment, it's a daily inverse head and shoulders. Left shoulder, head, right shoulder, key resistance. We know that if we get through that, we could move up to the next level. And interestingly, the gap fills at 246. Obviously, the core wall is around 250. So could we go to 280 after a breakout like this? It's very possible. It's going to probably coincide with the market also being ballistic. Remember, at the moment, we're at res, and there's another stock sitting at resistance. NVDA, a little bit lower than I thought it would be. I thought we might be able to get to 125 before the Qs would hit this zone. So it's doing well. It's kind of floating around here. And at the moment, could still easily see a pullback. Something like a 110 could be where the buyers sit for something like NVIDIA. It's kind of in the middle of nowhere land. Semiconductors are the same. They're definitely making it back up closer to that zone, thanks to, I guess, Broadcom and some other things. 242, pretty interesting level. This is a gap fill. Key res, interesting zone for the week. Certainly semis, that could be where the res is at. What about the international markets before we look at the other indices? Well, we've got Chinese stocks obviously improving. They didn't do too badly last week. I know a lot of you don't like this, but you got to remember that Chinese stocks are not about like a individual day trade too much. They're more of a, let's look at how a recession ends up bottoming, because they are and were in a recession. They're coming through it from price action standpoint, not from a news standpoint. Yeah. So the price action has bottomed back in January. And this is how markets do it. They get these huge rallies in, they get these huge dumps. It's a great study of a very critical period here in markets to see whether we actually are seeing a price action bottoming. From the perspective of whether we saw a nice rally, we did. Not great to see such a big rejection here in HSI. I would have liked to continue to see it through 17.5 to really get that momentum. But this is why we've got these key levels. So again, HSI certainly on the improve of where it has been. Another market improving straight into resistance is the Australian market. I do think Australian market is stronger. It's got the commodities base, the energy base, both beaten down, and a very strong financial move at the moment. So the Australian market, the old economy, kind of like the FTSE, the UK 100, both of them look like they're kind of rallying a bit here. And of course, this market could easily get to something like 8,800 over the next year or so. It's very possible for the Australian market to recover quite nicely. US 2K, remember it's behind the US by a lot if you look over a decade. The US 2K, nice bounce, not quite at big res yet. Big res is probably around 2220. Of course, people like Tom Lee really want this thing to monstrous numbers. I'm with him in some ways in terms of thinking the Russell needs to start to perform better. The other 493 stocks need to recover. We're starting to see that with RSP and obviously the Russell. But yeah, it was a nice pickup. And if you manage to get around the trap that was here on the low, this could be a big resistance. It's not quite there yet, so it'll be interesting to see if the Russell can get to that zone. When we look at the Qs, it pretty much nailed the key level. So this is the key level. This is a big zone for Qs. Most traded zone, big key res, certainly a point where I could see like a bear come back in and try to push the markets back down. Again, will these be the turning points? 465, we have the S&P 500 point, 55.12, 55.15, that kind of level. So they're the key levels. And if a pullback happens, these could be where we get back to. So watch the zones, put your opinion at the side, and recognize that what we do know is this is probably going to be a volatile event. And volatility can create opportunities. So you still need to keep a massive eye on these markets. Bitcoin, decent breakup. Obviously, first bull level, putting pressure on that. I'd say it's a pretty strong daily close. Love to see the weekly take out the weekly 20. And as we've suspected, we've been looking at recovery in the Bitcoin charts. And this is all ahead of obviously October, which we know is historically a pretty good month for Bitcoin. Bitcoin hates usually September. It's been a bad structure most of the year. It's still in an overall downtrend with a series of lower highs. But the break of the trend line towards the upside on the smaller time frames, the way it was interacting with the charts, that had us kind of thinking this thing was starting to recover. And at the moment, I'd say it's doing a decent job. Of course, if you're a longer term hodler, 54K was not the worst price in the world. Let's look at the news for the week ahead. We've got CPI coming out 1 hour before the New York market on Tuesday. Then we scroll down here and we've got the big one, the FOMC statement press conference How many cuts do we get? Current expectations are 25 basis points. Put down below your guess. I'm going to go 25 basis points. Let's see what you think. If you guess 75, you're a mad person, but I'm sure someone will do in the chat just to tilt me now. And overall, I think there's probably going to be 25. Now, the statement will probably be the most important component here with the press conference. So usually the market can move one way and sometimes it can reverse with the press conference. So remember, it's going to be a volatile event. And for people that are trading on leverage, you're going to need to be careful. Remember, overall, I guess we're still bullish on the market overall, no matter what kind of occurs here, because we are, of course, looking at the structure telling us that things have changed. And so far, what we're really knowing is we're late cycle, we've got to be cautious, but there's still buying out there and there's still leverage potentially that's going to come into markets. If you enjoyed today's video, then make sure to subscribe. Make sure to also check out our 7-day flash sale. Links in the description down below. We're putting out weekly newsletters all the way into Christmas. Make sure to sign up. Exclusive charts on those ones. And of course, if you're from Melbourne and Sydney, check out our free trading event. So it's going to be absolutely amazing, and I'd love to see you there. Thanks so much, guys. You have a fantastic weekend. We're going to kick some ass in the markets over the next month and a half. So join us as we discover how to figure out these nasty Wall Street traders.